Today, unnatural acts from New Zealand's Reserve Bank. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Yesterday, the New Zealand Reserve Bank released their November 2018 Financial Stability Report. They said that New Zealand's financial system risks had eased, but remain high. Slower mortgage lending growth and house price inflation have reduced risk, and they said that they were able to ease mortgage lending restrictions. So today we discuss this rather surprising move, especially given our recent discussions about the market there with Joe Wilkes. And by the way, if you value the content we produce, please do consider joining our Patreon program where you can support our ability to continue to make great content. Here is the link. The bank said that New Zealand's financial system is sound and risks have abated a little. However, vulnerabilities remain. Bank capital and liquidity ratios are in excess of current regulatory requirements and have increased over the past 12 months. And bank profits remain high, reflecting low operating costs and strong asset performance. While positive overall, banks' low costs have been partly achieved through underinvestment in core IT infrastructure and risk management systems in New Zealand. And while the financial system is currently stable, they say that risks remain that could challenge future stability. The principal vulnerabilities are high levels of indebtedness in the household and agricultural sectors, and the reliance on foreign funding of New Zealand's economy and banking system. Around 60% of bank lending is to the household sector, up from 50% in 1998, and as a result, relative lending to business has fallen. Indebtedness in the household sector is high relative to historical and international norms, with particularly large concentrations of debt in recent entrants to the property market and property investors. Mortgages represent 57% of bank lending. Those borrowers are exposed to an economic downturn that could cause household incomes to fall, as well as to lift increases in borrowing costs. These vulnerabilities are amplified by the heightened risk of a fall in house prices. When compared to other countries, New Zealand's household sector carries a high level of debt relative to its income. Debt in the sector is concentrated within certain types of borrowers. The most indebted households are typically those with mortgages, and those households tend to have higher than average incomes but have far higher levels of debt. Their debt to disposable income ratio is 325% on average, and it's near its historic high. Debt is further concentrated among those households with investment properties, those who have less time to pay down debt, and those who have purchased in regions with relatively high house prices, such as Auckland. The most vulnerable borrowers have debts that are large relative to both their incomes and the value of their assets. Only 1% of the value of new mortgages is to borrowers with both DTI ratios above 6 and LVRs above 80%, but over a third of borrowers look vulnerable on at least one of those metrics. So now what I want to do is to bring Joe Wilkes into the conversation because, of course, Joe is based in New Zealand and has been watching this closely. Hello, Joe.
Hi, Martin. How you doing?
Very good. Now, I think you were jumping up and down as much as I was when this speech came out.
Yeah, I'm not sure if I was jumping up and down, but I was shocked. It's a big thing that they're doing. It sounds like very little, but actually, when you dig into the nuts and bolts of what we've already got in New Zealand, that's when the real stability of the financial side of things comes into play. I've mentioned before, I've been working. I was working in the UK. I saw all this happen, and we very, very rarely got mortgages that were beyond 6 times household income. And then actually, when I looked over the financial stability report today, there's some astonishing things going on. I was shocked when I saw in the report that from the last 12 months mortgage data that the RBNZ released, 18% of mortgages were on between 5 and 6 times debt to income ratios. And debt to income ratios we discussed a little bit in our first post on the UK. Now, Northern Rock rarely got over 6 times debt to income ratios, and at the height of the boom, they were lending 6, and they did occasionally lend 7. So I was a bit shocked when I saw that, and then I don't know, my hair's still in, but I looked at the numbers, and we're talking about the last 12 months of lending in New Zealand. 25% of mortgages have been lent on multiples of debt to income, which are beyond 6 times. So in total, we've got 43% of borrowing issued last year, which is on 5 times debt to income and beyond. And you look at 25% beyond 6 times. We are, and this has been happening for a long time. We're in serious red light district where Middle Earth and the wonderful country that is New Zealand could turn into Mordor. It's horrific.
Now, the Reserve Bank introduced LVR restrictions in 2013 to address rising household lending risks. Easy lending standards were amplifying debt and house price imbalances, and ultimately were increasing the risk of a subsequent sharp housing market correction. The LVR restrictions have helped, they say, to lean against these risks by improving the quality of bank mortgage lending portfolios and reducing the number of households that are financially vulnerable. This reduces the risk that large numbers of households are forced to sell their houses or significantly reduce spending in a downturn. House prices remain high relative to incomes and rents and are therefore susceptible to a correction. However, momentum has waned in the housing market since early 2017, and credit growth to households has returned, they say, to more sustainable levels. Banks are also more rigorously assessing the ability of customers to service their loans, and this has seen a gradual reduction in the risks that the LVR restrictions were designed to mitigate. And housing market pressure is expected to remain subdued, which will further reduce risks over time. They make the point that many households may become financially stressed if a general economic downturn reduces their incomes, if their house values fall, or if their mortgage interest rates rise. And these risks have become particularly pronounced, in part because banks have allowed households to borrow large multiples of their incomes, while interest rates have been low. But interest rates have risen quickly in the past, and although this is not expected soon, international developments could see this happening again. The Reserve Bank's LVR restrictions have leaned against the build-up in risks from high household debt by increasing the amount of equity borrowers have to have in their homes. The restrictions with loans larger than 80% of the value of their homes fall from over 20% in 2013 to under 7%. This extra equity provides households with some room to avoid cutting consumption or defaulting on their loans if economic conditions deteriorate or if interest rates rise. The annual growth rate of housing debt has slowed from 9% in 2016 to 6% in September 2018, and they claim that household debt is now growing at a more sustainable rate, broadly matching the pace of household income growth. They show that compared with last year, more high loan-to-value loans are being written, and investors are taking more loans, this despite a slight fall in the proportion of interest-only loans and the debt-to-income greater than 5 times.
There's been a lot of talk about interest-only lending in Australia and how big it's got a proportion of the lending, but I know Westpac are up at 50% interest-only loans in 2017, so half their loan book was on interest-only. The good news is that New Zealand has reduced its proportion of interest-only loans. Bad news is it's still at 30%. Yeah, well, and that's a little bit of that. Are you being enticed into the market we talked about the other day? That's where the focus has changed from the investors to the first-time buyers who are being pumped with this credit. And people talk about, okay, well, it's fine if there's some equity that's come from mum and dad's home or it's come from another property. Yeah, that's fine. But if you're looking at 43% of your loan book on debt-to-income ratios of 5% and upwards and 25% over 6 times household income, 30% of your loans being interest-only. And when I was in the UK, the loan book of interest-only at pre-crisis levels got to probably around 18% of all loans. Today, and much of Europe, if you can borrow more than 4.5 times household income, you've done very, very well from a lending perspective, and you can't get it on interest only.
The price to income ratios are significantly extended in Auckland, sitting at 9 times. And for comparison purposes, New Zealand's household credit as a proportion of GDP is lower than Australia. Indeed, Australia is significantly higher at above 120%, then Canada at 100%, New Zealand at 90%, and with both the UK and the USA, as well as Japan, significantly lower. The New Zealand Reserve Bank says that this exposes the Australian financial system to a decline in the credit quality of outstanding mortgages, and households are particularly exposed to shocks to income, an increase in interest rates, or a housing market downturn. Banks have gradually strengthened their serviceability policies over the past 2 years, they say. Banks are now assessing households' ability to make loan payments against high living costs and interest rates. And in a recent exercise conducted by the Reserve Bank, banks estimated that the amount they will be willing to lend to a range of hypothetical borrowers. The results suggest that banks are willing to lend less to some of the same set of borrowers relative to their incomes than they were in 2014.
The governor's comments, he was very good. I have to say, I've got a lot of respect for Adrian Orr. He's been in the job for a year. And I think that he's taken on a mammoth task of keeping everything calm. But at the same extent, he said it in a little clip.
What is facing this industry? We spoke about quite a few different bits and pieces of uncertainty sitting out there at the moment for the housing sector. We've had the criteria for the quality of a house that can actually be rented, bright line tests around tax. These are already being factored in. And foreign investors. Yeah. Foreign investors. These are all quite big issues that are weighing on the housing market's future. And so that's in the hands of people who want to step up and borrow.
The housing market's future is in the hands of people who want to step up and borrow. That's step up and borrow. Nobody in the room who was interviewing, and there was a Q&A session afterwards, even thought to answer, does that mean that the economy is under severe strain if people don't step up and borrow?
And I picked up independently that same comment, because what basically he's saying is that we are stuffed unless people borrow more.
Yeah, it's dogs. I think he said dog's breakfast the other day. I said something worse, but it's been a real eye opener.
So now the Reserve Bank will ease LVR restrictions for new mortgages from the 1st of January 2019, up to 20%, increase from 15% of new mortgage loans to owner-occupiers, can have deposits of less than 20%. And up to 5% of new mortgage loans to property investors can have deposits of less than 30%, lowered from 35%. The Reserve Bank will continue to monitor changes in household lending risk and will further ease LVR restrictions if risks diminish as expected over the next few years. Household credit and home price growth remaining at sustainable levels will be an important consideration, as will banks retaining prudent mortgage lending standards. Now, 2 points to make. First, this weakening of standards is, to my mind, an attempt to slow home price falls, as such falls would, as they outline, create broader economic issues. But this is potentially adding further fuel to the high household debt fire at a time when it is likely that interest rates will rise ahead and households are financially stretched. Whilst they argue that banks' capital is stronger, it seems they are less worried about high household debt than I am. Second, these tweaks are still somewhat marginal, and lending in New Zealand is still more controlled from a macroprudential perspective than Australia. Yet we are seeing signs of more significant home price falls in Australia, and reading across to New Zealand, the signs are there in terms of lower settlements and higher listings of more trouble ahead in both markets. So we regard the Reserve Bank of New Zealand's action as an unnatural act to prop up home prices, and we expect to see more such moves on both sides of the Tasman ahead. But just remember, high household debt is the issue that needs to be addressed. Home prices are an outcome of credit availability, not the other way around.
And I just wanted to add one more thing, because there will be people here who do care and do want to understand. I've got some of the information that I've got recently from a firm in New Zealand, interest.co.nz. Yes, there are stories that are property related, some are positively property related, some aren't, but actually from a data perspective, it's been very useful. So if you want to know more than you're going to get from the Herald in Auckland and the Dominion Post and stuff as a website, go and get some data. Hopefully you'll understand things a little bit better. Please feel free to get in touch with me. And if I were to return to the north of England, where Northern Rock were loaning 6 times multiples of household incomes, there are large swathes of the country where people just can't move still. This is 10 years after the crisis, or 11 years after the crisis now. And those debt to income levels, they're not sustainable. They're probably, to be fair, more sustainable in a European environment where costs of food are lower, generally petrol prices are a little bit more reasonable, where your energy prices are slightly more controlled, and where you're paying £1 for 2.27 litres of milk, where in New Zealand now it's $3.50, which is on a pound equivalent, it's about £1.90 for 2 litres. So those things haven't been factored in, and I can understand why the governor. He was very good, but he wasn't very well questioned.
And I think that's an object lesson. Clearly, the press should be watching the DFA site to get hold of the right questions to ask.
Absolutely, and I'd love the opportunity to sit down there with them.
Thank you, Joe. We'll talk again soon.
And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our abilities to make great content. The link is in the comments below. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.